Let's understand how stock prices are determined in the market. Stock prices are fundamentally determined by supply and demand dynamics. When more people want to buy a stock than sell it, the price rises. Conversely, when more people want to sell than buy, the price falls. This balance is influenced by several key factors. Company performance, such as earnings reports and new product launches, directly impacts stock prices. Economic conditions like interest rates, inflation, and GDP growth affect the entire market. Investor sentiment represents the overall attitude of investors, which can be influenced by news and social media. Market trends include sector movements and technical analysis patterns that traders follow. The actual stock price at any moment is determined through the order book system. When a new buy order enters the market, it's matched with the lowest available sell order. This transaction establishes a new market price, which becomes the last traded price. Stock prices continuously adjust as buyers and sellers interact in the market. To summarize, stock prices reflect the balance of supply and demand, influenced by multiple factors and determined through the continuous matching of buy and sell orders. Stock market orders come in several varieties, each designed for specific trading strategies and situations. When trading stocks, investors use different types of orders to control execution timing and price. Let's explore each type of order and how they work in the context of market price movements. Market orders execute immediately at the current best available price. They prioritize execution speed over price precision. When you place a market order, it will execute at whatever the current market price is, which could be different from the last quoted price you saw. Limit orders let you specify the maximum price you're willing to pay when buying, or the minimum price you'll accept when selling. For example, a buy limit order at $50 will only execute if the stock price is $50 or lower. This gives you price control but doesn't guarantee execution. Stop orders trigger when a stock reaches a specified price, at which point they convert into market orders. For example, a sell stop order at $65 triggers when the price falls to that level, helping to limit losses in a declining market. Once triggered, the stop order becomes a market order and executes at the best available price, which might differ from your stop price. Stop limit orders combine features of both stop and limit orders, giving you more control over your trade execution. You set two prices, a stop price that triggers the order, and a limit price that sets the minimum or maximum price for execution. Once the stock reaches your stop price, it becomes a limit order that will only execute at your limit price or better, protecting you from unfavorable price movements. Stock market orders also vary based on how long they remain active. Day orders automatically expire at the end of the trading day if they aren't filled. These are the default on most trading platforms. Good till canceled orders remain active until they're executed or manually canceled. Most brokers set a maximum duration of 30 to 90 days for these orders. Let's compare the different types of stock market orders and their key characteristics. Each order type serves different needs. Market orders provide immediate execution, while limit orders give you price control. Stop orders and stop limit orders help manage risk, and time-based parameters determine how long orders remain active. Understanding these order types allows you to implement more sophisticated trading strategies and better manage risk when investing in the stock market. Stock markets cycle between bullish and bearish phases. These cycles are natural parts of market behavior, featuring periods of growth followed by contraction. Bull markets are characterized by rising prices, investor optimism, and economic growth. These bullish phases typically last longer than bear markets, with an average duration of 4 to 5 years. In contrast, bear markets feature falling prices, generally defined as a 20% or greater decline from recent highs. Bear markets are characterized by investor pessimism and economic contraction, typically lasting between 9 and 18 months. The transition from a bull to bear market is officially marked when prices fall by 20% or more from their recent peak. Recognizing these market cycles helps investors adjust their strategies accordingly. By understanding the characteristics of bull and bear markets, investors can better navigate market cycles and potentially improve their long-term results. Market volatility measures how quickly and significantly stock prices change over a specific period of time. Let's compare low and high volatility markets. Low volatility markets show gradual, predictable price changes. High volatility markets, on the other hand, experience rapid and significant price swings, making them less predictable and potentially riskier. The VIX index, often called the fear gauge, is a real-time market index that measures the market's expectation of 30-day forward-looking volatility. During calm markets, the VIX typically stays at lower levels, around 12 to 20. As market anxiety increases, the VIX rises. During times of market stress, it can spike above 30 or even higher. Market volatility can be triggered by several key factors. Let's explore the main causes. Economic data releases, such as GDP reports, employment figures, and inflation numbers, can cause significant market reactions when they differ from expectations. Geopolitical events like elections, military conflicts, and international trade agreements create uncertainty that often translates to market volatility. Company earnings reports, especially from market leaders or bellwether stocks, can spark volatility across entire sectors or even the broader market. Changes in monetary policy, particularly interest rate decisions by central banks like the Federal Reserve, are among the most powerful drivers of market volatility. Volatility is a double-edged sword in the financial markets, presenting both risks and opportunities for investors. On the risk side, volatility increases uncertainty, can lead to significant losses if timed poorly, and often triggers emotional decision-making that harms long-term returns. However, volatility also creates opportunities. Active traders can profit from price swings, options traders can leverage volatility with specific strategies, and long-term investors can purchase quality assets at discounted prices during market downturns. Understanding market volatility is crucial for all market participants. While it cannot be avoided, it can be managed and even used advantageously with the right strategies and perspective. Stock markets operate in two distinct phases: the primary market and the secondary market. The primary market is where companies first issue new shares to the public, typically through initial public offerings, or IPOs. In the primary market, companies raise capital directly from investors. The money flows from investors to the company in exchange for newly issued shares. The secondary market, on the other hand, is where previously issued shares are bought and sold between investors through stock exchanges. In the secondary market, no new capital is raised for companies. Investors simply trade existing shares with each other, with the company receiving no direct financial benefit. Most daily trading activity takes place in the secondary market, which accounts for approximately 95% of all trading volume. The secondary market serves two crucial functions. It provides essential liquidity for investors wanting to buy or sell shares, and it helps establish fair market prices for securities through the continuous process of trading. Modern stock markets rely heavily on technology that has dramatically changed how trading works. Electronic trading platforms automatically match buy and sell orders using sophisticated algorithms. High-frequency trading firms use powerful computers to execute thousands of trades per second, capitalizing on tiny price differences across markets. Dark pools are private trading venues that allow large institutional investors to trade without revealing their intentions to the broader market, preventing market impact. Trading apps have democratized market access, allowing retail investors to trade from smartphones with minimal fees and without the need for traditional brokers. These technological advances have dramatically increased market efficiency, reducing trade execution times from minutes in the past to microseconds today. While these technologies have improved market efficiency and accessibility, they also introduce challenges like market complexity and the need for robust regulations. To start investing in stocks, your first step is to open a brokerage account with a reputable firm. Popular options include Fidelity, Charles Schwab, Robinhood, TD Ameritrade, and Vanguard. Each offers different features that might better suit your individual needs. When choosing a broker, consider factors such as fees, user interface, research tools, customer service quality, and account minimums. The second step is to research companies you might want to invest in. Examine financial statements, including income statements, balance sheets, and cash flow statements, to understand a company's financial health. Pay attention to key metrics such as price to earnings ratio, earnings per share growth, debt to equity ratio, profit margins, dividend yield, and return on equity. For beginners, it's often wise to start with index funds or ETFs. Unlike individual stocks, which carry company-specific risks, index funds provide instant diversification by investing in hundreds or thousands of companies at once. Popular options include S&P 500 index funds, total stock market funds, and NASDAQ 100 funds. These funds offer benefits like instant diversification, lower management fees, and simplicity, making them ideal for new investors. The fourth step is to develop an investment strategy tailored to your personal situation. Your time horizon is crucial. Short-term goals might require more conservative investments, while long-term goals allow for more aggressive growth strategies. Your risk tolerance determines how comfortable you are with market fluctuations. It ranges from conservative to aggressive. Based on these factors, you might adopt value investing, growth investing, or income investing strategies. Each approach has different goals and methods. Step 5 is to implement dollar cost averaging, a strategy where you invest a fixed amount at regular intervals, regardless of market conditions. This chart shows how stock prices fluctuate over time. With dollar cost averaging, you invest the same amount each month. When prices are high, your fixed investment buys fewer shares. When prices are low, the same amount buys more shares. This naturally leads to buying more at lower prices and less at higher prices. Dollar cost averaging reduces timing risk, creates a consistent investing habit, lowers your average cost, provides emotional discipline, and works effectively in all market conditions. The final step is to maintain a long-term perspective. This is perhaps the most important aspect of successful investing. Looking at historical market performance, we can see that despite significant downturns, the overall trajectory of markets has been upward over extended periods. Major market downturns like Black Monday, the dot-com crash, the 2008 financial crisis, and the COVID-19 pandemic caused temporary declines, but the market recovered each time. Remember these key takeaways. Markets trend upward over the long term. Short-term volatility is normal and expected. Research consistently shows that time in the market beats timing the market, and patience is crucial for investment success. Let's summarize the 6 steps to start investing in stocks. Open a brokerage account, research companies thoroughly, consider index funds for diversification, develop a personal strategy, implement dollar cost averaging, and maintain a long-term perspective. By following these steps and staying disciplined, you're well on your way to building a successful investment portfolio. Remember that investing is a journey, not a sprint, and consistent action over time is the key to success.